Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Emaad Akhtar with Ryan Huang. Now, Ryan, tomorrow is July the 1st, and some sources tell me that July also tends to be a solid month for markets. Historically, it's been the strongest month for the Dow Jones and S&P 500 in terms of average monthly performance.
Well, that's great news because we are coming off the back of record highs on Wall Street last Friday. So will that mean things will go up higher? Well, let's check in now at Phan Vee Leung. He is the CIO for Trackrecord. V, good morning. How are you doing today?
Hi, good morning. Let's talk about markets.
Awesome. Now let's talk about what is going on with markets first. And we've got record highs on Wall Street, and that's with Friday's close. And of course, in the backdrop is actually a lot of things to worry about. You've got geopolitics, you've got tariffs, so a lot to look at. So when you look at what's been playing out in the markets, what's different this time when you consider what played out in the earlier record highs that we saw in February?
I think since February, quite a lot of things have changed. The world came close to the brink of World War, in fact, nuclear war as well. And inflation has continued to surprise to the downside. On the whole, the economic data has been more friendly for the narrative for the Fed to continue to resume cutting interest rates. For example, jobs growth has dropped, and we have seen inflation surprise to the downside and no signs of the surge in inflation that markets was fearing from Trump's tariffs. But, as you said, geopolitics has been a big hurdle to the market, a big problem. We saw Israel-Iran situation, which for now is in a ceasefire. And, of course, the promise to end the Ukraine-Russia war has not yet been fulfilled. So we've seen a lot of noise around that, right? We've seen markets correcting repeatedly, and we've seen aggressive sell-offs that have since been negated. So I think one thing that the bull market has to overcome, usually the bull market is formed when there's a lot of worries. It's not like when it's very obvious that it should be going up, then everybody is invested. There's no more marginal buyers, right? So what we are seeing is a bull market form where the markets are climbing the wall of worry. So one thing that I believe will continue to drive the markets higher is that investors are mostly underinvested now. Some surveys have shown that only 30% is allocated to their benchmark. So that's kind of like the situation that they don't want to be in. We are seeing, as you said, all-time highs in Nasdaq and S&P, and yet they are underinvested. So what we will see going forward, unless there's a drastic change in the global macro picture, we're going to see all of these underinvested investors having to buy on dips. As we have seen, every dip has been met with buying. The sell-offs have been quite brief. And unfortunately for them, if it continues to grind higher without a deeper dip, they have to chase the markets. That's what we are seeing right now, right? That sell-offs are shallow and they have to chase the market higher. And of course, volatility has continued to drop as we've seen the markets unable to sell off in a very aggressive fashion.
Yeah. So we've also got that narrative of fund managers globally talking about moving away from the US, not investing back their money in the US. So is that overplayed to some extent when you see how Wall Street is going higher?
I think yes. Of course, we are seeing people are trying to avoid the US, right? Because of various reasons, political as well as geopolitical, as well as the fact that Trump is also speaking of starting a shadow Fed, which is meaning that he wants to name the successor to the Federal Reserve Chair before his term ends, so that he can undermine Powell's credibility a little bit, right? But all these are minor problems. I think the reason why the U.S. is the primary investment target is because of the liquidity, the size of the markets, right? There's really no markets that's big enough to accept all these investments. And yes, we've seen diversification out of the U.S. That's why we see the U.S. dollar being very weak. It's been closing weaker for quite a number of days against, for example, the euro. I think it's 7 days in a row of euro rising against the US dollars, which is not something that happens very often. So, yes, we've seen Nikkei grinding higher, outperforming, in fact, the US rally. So we will see people trying to allocate to other markets as well. And I think, for example, China, Hong Kong markets will start to do better as the underperformance in China that we've seen in the last few years is starting to become something of the past.
Yeah, Vee Leung, I guess it remains to be seen how sustainable these highs will be in the face of mixed economic data, including labor market uncertainty, inflation stickiness. Speaking of the former, a big one that market watchers are looking out for, U.S. non-farm payrolls coming out later this week. Now, they did rise by 139K in May, but the June figure is expected to slow to 100,000. Your expectations?
So I've been in the market for a lot of years, right? And it's really difficult to guess what each number will be. And in fact, the revisions to the number after you've guessed it, it's quite big as well, right? It's a 50,000 or randomness. It could be either way, right? But I think it's around expectations between 100 to 130,000. It's somewhere around that. It will bring down the 6-month monthly average per month for the last 6 months, for the first 6 months of this year, around 120 to 125,000 jobs created per month. This is a far cry from the last 6 months of last year of around 170,000 per month created. So what we are seeing is, although there's still jobs growth, although the jobs market is resilient, but it's coming off. It is starting to trend lower. So if we should see an uptick in the unemployment rate and a big drop in monthly jobs created, we will see the probabilities of interest rate cut in July rising. Currently, it's around 18 to 20%. That's a possibility of a cut because like 2 to 3 Fed speakers, Fed voters last week, they started to talk about we should resume rate cuts, right? And the narrative is changing. Of course, the chair, Powell, still sticks to his waiting and seeing more data before he decides. So the higher probability is for a September cut, but I think the odds of a July cut is starting to rise because more Fed voters is coming around to that. With inflation underperforming to the downside, surprising to the downside with no spike in inflation that they have been fearing, they have revised, since the start of the year, they have revised their inflation forecast up in expectation of Trump's tariffs, but that has not yet been seen in the data. So I think the narrative for a resumption in rate cuts is starting to get stronger. So that should boost risk sentiment and encourage more people to invest in U.S. markets as well.
Okay.
In expectation of better economic situation.
So by and large, it looks like risk appetite is back on. Briefly, V, what are you looking at that looks attractive to you in the markets at the moment?
To succeed, you just got to go with the trends that have been pronounced. So buy the dips in U.S. equities. And of course, another thing that's on my radar is oil prices. I think after the spike in oil prices because of the conflict in the Middle East, many of the positions that are short, leverage short investors, they've all been wiped out. And even on the day of the attack, Iran retaliated against the U.S. Oil prices, instead of spiking up, went down straight away. We are also seeing OPEC Plus, I guess the cartel that controls oil prices around the world. They have also been rumored to be agreeing to raise output again in the upcoming meeting in a week's time. So I think we are going to see more downside in oil prices, which will be good for risk sentiment and good for stocks and good for inflation. And hence, we will see the trends continue to exert itself on the market.
All right, so buying dips in U.S. equities and expect oil prices to resume their downtrend. Thank you for that summary. Phan Vee Leung is the CIO of Trackrecord. Thanks for your time this morning, sir.
All right, thank you. Cheers.
Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.